It's a perfect asset to add to portfolios. It's like salt for food. As an asset, it has historically high returns. It has low correlations to other assets, meaning it zigs when stocks sag, and it's liquid. And in the history of finance, you've never really been able to combine those things. The people that matter are shouting at the world that this is going to happen. And the world is like, no, no, no. Go see what the chair of the SEC is saying, or the CEO of BlackRock, or the CEO of DoubleLine, or like see what those people are saying. They're all saying the same thing, which is like, this is inevitable. This is the way it's going to go, and it's going to go faster than you think. The chair of the SEC, the most important regulator in the world, says all assets will move on chain in the next handful of years. The CEO of BlackRock, the largest asset manager in the world, says we're tokenizing all of our funds in the next 3 to 12 months.
In recent years, the conversation around Bitcoin and digital assets has shifted dramatically. What was once viewed as a speculative experiment on the fringes of finance is increasingly being discussed as a legitimate component of long-term investment portfolios. According to Matt Hougan, one of the most prominent voices in institutional crypto investing, the case for Bitcoin today is not simply about speculation or short-term price movements. It is about portfolio construction, financial infrastructure, and the long-term transformation of global markets. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
It's a perfect asset to add to portfolios. It's like salt for food. As an asset, it has historically high returns. It has low correlations to other assets, meaning it zigs when stocks sag, and it's liquid. And in the history of finance, you've never really been able to combine those things, right? You would have maybe venture capital, which has low correlations, but it's illiquid. You can't trade it. You would have gold, which historically has had low correlations and was liquid, but didn't usually have high returns. This is like the first time you have an asset that has all three of these characteristics. And as a result, when you put it in a portfolio and you rebalance, it has this incredible effect of lifting your returns. Just like salt, it's not the only thing most people would want. You wouldn't sit down to a plate of salt, right? That would be terrible. You wouldn't have 100% of your portfolio in crypto. That would be very volatile. But when you add a little bit to your broader portfolio, what that data shows is literally there've never been a 3-year period where it didn't boost your returns. Never. Across 12 years. It's a remarkable thing.
How much Bitcoin actually makes sense?
I'll give you two numbers. Up to 5% makes the most sense for most people. And the reason for that is really specific, which is the biggest risk when you buy crypto is that it's so volatile that you make dumb mistakes. So you chase it when it goes up or you panic when it goes down. That's how people lose money in crypto. The beauty of 5% is that historically, when it's under 5%, it's not the thing that drives the overall volatility of your portfolio, right? That's still stocks that are driving whether your dollar amount goes up or down. And so you can handle if Bitcoin falls 20%, it's like no big deal.
Yeah.
Once you get above 5%, that stops being true. In my personal portfolio, it's much more than that.
Same.
So that's the other number. It's 30, 40%. But I have very high conviction and very long time horizon. And so that's not recommended for most people who don't exist in crypto all the time. I think we're in a classic bottoming cycle, right? Crypto went into a classic 4-year winter. It goes into a winter every 4 years that happened on schedule starting in October of last year. It drew down about 50%. And now we're in that process of bottoming out and starting to head up to new all-time highs. Behind the scenes, there's so much great news in crypto. There's progress from a regulatory perspective. There's progress from institutional adoption. There's progress from Wall Street building in the crypto market. We just have to work through this period. Historically, this has been interesting times to buying at these sort of bottoming moments. That doesn't guarantee that will be true in the future, but I'm really optimistic about where the price is going, even in the rest of this year. The way I think about there are all these different kinds of investors, and they're sort of moving into Bitcoin at different paces. We've seen a lot of institutional investors and financial advisors who previously had 0% of their portfolio in Bitcoin going to 2.5 or 5%. That's happened even as the price came down. Those people were still buying. The reason the price was coming down was some of the people who bought Bitcoin originally 3, 5, 10 years ago were selling some of their holdings. But absolutely, people who used to own only stocks and bonds, or who owned only stocks and bonds and maybe a little bit of gold, now realize that they need to have more than 0% in Bitcoin. And we see that in the flows in the ETF.
Bitcoin ETFs, they exist here in the US finally. How has that changed the way that Bitcoin's price is discovered, I guess, in the market?
Yeah, it's brought in, you can think of it as bringing in a whole new type of investor that invests in a different way, which means the volatility has come down and actually the price has just gone up. I think Bitcoin was $40,000 before we had ETFs, and now it's 70 and it's been much higher. But I think it's really important to think about that different type of investor. You know, before ETFs, crypto was mostly retail investors who move money pretty fast and don't regularly allocate to the space. What ETFs brought in was more institutional investors, and they do two different things. So they invest for the long term, typically. They don't trade as much. And then they invest a little bit every 2 weeks or every month or every quarter, right? Like many people do in their retirement account. And that has the effect of sort of counterbalancing some of the fast moving money on the retail side. So you've seen volatility come down. Crypto's still very volatile, but now Bitcoin is actually less volatile than Nvidia, which admittedly, Nvidia is a very volatile stock, but it used to be like a couple times more volatile. So it's sort of calmed it down. It's put it more into the institutional framework.
Do you think that ETFs are going to ever lead the market?
A bunch of people in Bitcoin won't like that, but a fact of the world, for better or worse, is that professional investors control most of the money. And most of them are going to gain exposure through ETFs. So ETFs will be one of the primary sources of price discovery and one of the drivers of the market. They won't be the only one, but there'll be periods where they're the biggest force in the market for sure. You know, the people think of ETFs as like the only way people have ever invested, and of course that's not true, right?
Yep.
ETFs disrupted mutual funds, which disrupted closed-end funds, which disrupted individual stock. Like there's been a history of evolution. I think the next evolution is vaults. Vaults are like ETFs, except for the asset manager doesn't do some of the things that we do with ETFs, where we take your assets ourselves and we hold them at a custodian in a pooled vehicle. It's more like we design the exposure and you keep custody of the assets. It's more transparent. It's more on chain. And I think eventually vaults will be, you know, 30, 50 trillion dollars. It's a more efficient design for providing asset management to people with more transparency and more security when it's fully mature. So yeah, I think they're ETFs 2.0. I think the market is moving in that direction. They're very small right now. This is akin to ETFs in like 1997 or something. But look at ETFs now. They're the only way most people invest. And eventually that will be true of vaults too.
One of the most significant developments in recent years has been the arrival of Bitcoin exchange-traded funds. These financial instruments have fundamentally changed the way institutional investors access the crypto market. Before the introduction of ETFs, the majority of crypto investment came from retail traders and early adopters.
From a market structure perspective, what changed in that weekend?
This was last weekend when the U.S. Started its bombing in Iran. President Trump announced that at 2:30 a.m. on Sunday Eastern time. And 2:30 a.m. is this like really unique moment in the market because everything is closed. The U.S. stock market is closed. The U.S. futures market is closed. Asian stock markets are closed. European stock markets are closed. There's basically nothing available. And so what happened is that everyone who wanted to express a view in the market turned to the only thing that was open, which was crypto. They turned to Hyperliquid, which is a perpetuals futures exchange. They turned to Bitcoin and Ethereum, and they started trading those in size to the point where when Bloomberg reported on what was going on with oil as a result of Iran, they actually looked at what was happening on crypto-based rails in Hyperliquid. And that was like the definitive source. I'd never seen that before in 8+ years of working full-time in crypto. The reason it's important is, look, there are these two parallel financial systems that have built up in the world. There's the traditional system where everyone operates, and there are these crypto rails, which have these real advantages. They trade 24/7, 365. They're much cheaper to use. They're much faster to use. But unless there's a crisis moment, nothing forces traditional investors to look at these things. They're okay just using these traditional rails. I think why this weekend was so important is that it was a crisis moment where all these people had to learn in a hurry how to use these traditional rails. And once they make that leap, once they have a digital wallet, once they own stable coins, they'll start to realize all the things that they can do in this. So I think the genie doesn't come back in the bottle. I think this was like a starting signal for Wall Street really getting comfortable with crypto-based rails. I think it was a really important moment sort of in the history of DeFi and crypto growth. So there's a piece of legislation in Congress called the Clarity Act, which fundamentally defines how regulation would work in crypto. And I do think a lot of institutions are waiting for that to pass before they really invest in the space. Yeah. The reason for that, just for the audience, is right now the regulatory environment in crypto is really good, right? Institutions are comfortable being in crypto, but under a new administration, that could reverse. And the reason the Clarity Act is important is once it's built into the law, it's like putting a concrete foundation under crypto. And so they can really start to build on that. Hopefully, we're going to see that pass soon, right? I think the odds on prediction markets are above 75% now. So the reason they have anchoring bias is the first time they heard about crypto was after Silk Road or Mt. Gox or FTX or something negative.
When the sentiment was super negative, yeah.
Super negative. That's when you get the first media story. And so they have that as their view of crypto. But if that wasn't true, I mean, everything is there. The chair of the SEC, the most important regulator in the world, says all assets will move on chain in the next handful of years. The CEO of BlackRock, the largest asset manager in the world, says we're tokenizing all of our funds in the next 3 to 12 months. The largest credit manager in the world is buying a DeFi asset. I mean, it's like the people that matter are shouting at the world that this is going to happen. And the world is like, no, no, no. What metrics do we have to see? As stablecoin growth grows, that's a good metric. As DeFi TVL grows, that's a good metric. But I would really encourage people to try to remove their anchoring bias and go see what the chair of the SEC is saying, or the CEO of BlackRock, or the CEO of DoubleLine, or see what those people are saying. They're all saying the same thing, which is this is inevitable. This is the way it's going to go, and it's going to go faster than you think.
Also, we have Google.
It's wild to me. Of course, the good thing as an investor is that craziness is your opportunity, right? The biggest returns in the market come from when other people are being irrational. And I think there's a strong case to be made. The world is largely being irrational about DeFi, stablecoins, tokenization, and part of crypto. They're just not willing to look at the reality that, as you said, you can just Google. And there it is. The scale of tokenization, I think they'll completely rewrite. It's so much bigger than people are giving it credit for, right? Again, it's $20 billion and it could be $200 trillion. $200 trillion is like a lot. I'm saying that because, equities are 100 trillion, bonds are 250 trillion, right? It just has to capture a big chunk of that to be a $200 trillion market. I think they're going to look back and wonder why they didn't listen to Paul Atkins at the SEC and Larry Fink at BlackRock when they were telling you $200 trillion is coming down these paths. Just seems crazy to me. The way I invest in that space is you want a little bit of all the people who are playing with it. You want to own the protocols like Ethereum and Solana that host those assets. You want to own the companies like Circle and Figure and Robinhood and Coinbase that are leading in that space. You want to own some of the service providers. So an asset like Chainlink is a service provider to the tokenization market. They're like a data provider for everything tokenized. And you just want to own everything you can associated with it, because what you're confident in, or what I'm confident in, is that tokenization is going to be 10,000 times bigger than it is today. I literally mean that. There's about $20 billion tokenized today. I think that'll be $200 trillion in the future. So I have high confidence in that. Everything will be tokenized. But who wins? I just have less confidence. And so if you have this, like I listed 6 things, 2 of them may be worth nothing. It's fine. As long as I get the 4 things that will participate in this massive growth. There are other people smarter than me that can probably pick the one, but that's how I approach it, is just own the entire space. I think public decentralized wins in the long run. Look, in every technology battle, there is always this debate of closed and private, which is more secure and easier to get your hands around, or open. And open usually wins, not every time, but 90% of the time. In the early days of the internet, people talked about corporate intranets, or you had things like AOL that were these walled gardens, but that can't compete with the internet, right? No one wants a little walled garden. I think that will be true here. The world is global. It wants to be open. It's harder for institutions to get comfortable with the open, wild world at first, but eventually that's the more powerful solution. So I think that's what will win out.
The evolution of Bitcoin and the broader crypto ecosystem is no longer just a story about speculative trading or niche technology. It is increasingly a story about how global finance itself may transform in the coming decades.